Hello and welcome to Market Guru. I'm Deepanshu Bhandari, and joining me on the show today, Chakri Lokapriya, the MD and CIO at TCG Advisory Services. He's in our studios. Chakri, good to have you as always. Lots to talk about, Chakri. Let's talk about the markets first. It's been a stellar rally, and it's been that way for the last 6 months or so. What's driving this rally? Because fundamentally, what's changed so much for India that the markets have rallied, they've outperformed global markets, the market capitalization has gone up, valuations have gone up quite significantly, and we are holding on. So despite any kind of negative flow that comes in, we continue to gain from strength to strength, hit new records day in, day out.
I think 2 or 3 things have happened, which are a happy confluence of events. One, globally, the economic growth for both the US and EU has bottomed out, and they're all growing strong. So Indian component of export earnings, I'm not talking about pharma and IT, but like metals, mining, has improved. Second, India has managed to get its fiscal deficit in order, and that's good news for the currency, and also it has led to a certain amount of currency appreciation. Rupee is up about 7% this year. That usually brings in the foreign investors, FIIs like us, because it adds to your returns. And third, if you look at earnings, have been extremely low for the last 3 or 4 years. And so while earnings still have not recovered strongly, I think market is anticipating an earnings recovery.
Is that going to happen? What do you make of those Q4 earnings? Because we've been talking about this quarter in, quarter out. Yeah. And I mean, apart from you, of course, there have been other market experts who are expecting some kind of earnings recovery, but that's not happened so far, at least, both either on a Q4 basis or even if you analyze FY17 as a whole. Are there indications that 2 quarters down the line, maybe it'll get better?
You're right. Every time, I've come and looking over the last couple of 2-3 years, we've been anticipating an earnings recovery which has been postponed. And each time it has been postponed due to various reasons. First it was Brexit, first it was Fed uncertainty, then Brexit, then demonetization, and now GST. So each time there's a brand new factor which you didn't anticipate before. So from that perspective, now we have GST coming up. So there's likely to be a temporary dip in earnings for the next 2 quarters as companies deal with how to readjust themselves to the new tax regime. Now, all these pent-up lost sales and demand have to translate into earnings. And mind you, we are going into elections in about less than 2 years from now.
That's right.
So the government will have to do its final push sometime towards the end of this year, that is 1 year before the election. And that's the big hope.
On that GST front, because I was talking to the management of V-Guard today morning, and they were of the view that for the current month at least, and maybe in the next month, you will see a dip in offtake from their wholesalers, their distributors, as they try and get rid of the inventory ahead of the GST rollout. And this could be a trend that you could see across sectors, across companies as well, the inventory destocking part of it. Is that going to significantly affect earnings in the short term, at least for some of these consumption-related sectors in particular?
We're beginning to see the trend of wholesalers and stockists and various levels have been cutting their inventory because of uncertainty of the taxes and the input credit that they will get. And as a result of that, yes, you will see a good amount of slow sales. You're also beginning to see in the case of automobiles, whether it is commercial or passenger, both are seeing a slowdown because you're waiting for the new rates to come. 2 things are likely to happen. So existing inventories across board, whether it's big ticket items like cars or 2-wheelers or small ticket items of even a Hindustan lever types, they'll all try to push out inventory, which means there will be a pricing cut.
That's right.
Without knowing what the new tax rate is going to be. And so they'll say, let's get rid of the stuff, figure out later. And meanwhile, which means, yes, there is going to be an earnings cut. But you can, if you look at the corollary to that, all these sales have to come back at some point in the future, which means your future earnings growth, maybe late FY19, will be a better than expected. You'll see an upgrade in earnings.
This is the same argument that was put forward in demonetization as well.
Yeah.
Did we see that uptick in Q4 earnings?
Now, if you look at FY18 and FY19 earnings, you can see that the consensus is about 20% earnings growth, and about 20-22%, top line growth of maybe 8-10%. Where is this coming from? Some amount of sales was lost because of demonetization. That sales got pushed out. And so people who wanted to buy a car anyway or to buy anywhere in December, November, December, January did not do that. And they bought it in March, April kind of a time frame. So that pushed out, and therefore this quarter earnings looked marginally optically better.
Right.
And this led a certain amount of uptick in FY18 and FY19 numbers. But now with GST, you're going to see a great amount of flux in earnings upgrades and downgrades for various sectors. So it's tough to actually come out with a number, at least for FY18. So I think FY19 you will be a stronger number.
FY19 could be a stronger number. So, but fair to say GST short-term disruptive on growth?
Short-term, yes, there will be a blip as companies readjust to the new reality.
Considering all of this, GDP was at a 9-quarter low in Q4, at a 2-year low as far as FY17 is concerned. Inflation has been cooling off. GST short-term disruptive for growth. Should the RBI go in for a rate cut tomorrow?
Great question. The answer, I think, unfortunately, RBI may not cut when it should be cutting the rates, simply because private capex is low, NPAs are high, inflation is low, liquidity is high, and private companies are still struggling, and banks are not passed on the entire rate cut from the past. So probably they've cut about 1% You still have like 75 basis points of past rate cuts, which has not yet been passed to companies. Against this backdrop, we'll probably hear talk about waiting for monsoons, which, I mean, a normal monsoon is a normal monsoon.
Exactly.
Shouldn't prevent an RBI from cutting rates. We do hope they surprise and we're all wrong and they do cut rates tomorrow.
But even if it's not tomorrow or next policy, is there scope for a large cut over the next 1 year, or would it still be about 25 to 50 bips?
It's unlikely that it's going to be anything more than a 50 bips in cumulative, simply because I think we're towards the end of the cycle.
Right.
And the RBI has greater things on its plate in trying to figure out this NPA mess and how it's going to get resolved, because they're going to shortly announce corporate defaulters.
Right.
And that opens a brand new set of
Headaches.
issues.
In fact, let's talk about the NPA headache, because looking at Q4 earnings in particular, while it hasn't gotten worse, it hasn't gotten significantly better either. Asset quality stress remains elevated for most of these banks. There have been 3 banks that have already come under RBI's prompt corrective action list. There is indication that 7 more are on the radar at least. RBI and rather the government is talking about mergers of PSU banks, stronger ones with weaker ones. There's been a lot of talk in terms of the NPA resolution, but it's not happened yet. Do you feel that now, with the kind of systems that have been put in place and the overdrive that's coming from both the government and the RBI, we could be seeing some kind of softening as well as NPAs are concerned? Or there could be a bigger headache in the form of telecom, which has now become the key concern?
Telecom and even other sectors, telecom is probably has 100,000 crores worth of NPAs cumulatively sitting on the books. I think it's time for somebody to step back and think that, look, spectrum prices need to come down. Maybe there's going to be a greater revenue share in the sector or whatever, but the companies are not able to service the debt. And then you have elections coming up in about less than 2 years. So various state government, Maharashtra, 30-40,000 crores loan waiver.
That's right.
UP is already announced. A couple of other states will also join the bandwagon, and before you realize, that will be another 100,000 crores. So this adds to the existing NPA problems. So therefore, it becomes primary to solve the existing problems first. A good amount of it, if you take companies like Axis Bank and a few other banks, they've sold it to various ARCs, asset reconstruction companies. And while that is only a part of the solution, I think merging banks is a tough solution in India. Maybe like this very smaller ones will be absorbed into the bigger ones, but trying to get 2 big ones to do the job is unlikely to happen.
So what are you doing with PSU banks right now?
Corporate banks are still the place to be, because corporate banks are in the worst possible shape that they are in. And we believe that the bigger the problems, the greater the turnaround, and therefore the greater the upside to stock prices. So whether it is an ICICI or an Axis Bank on the private side, or even the PSU banks, we are positive. And mind you, today's QIP of State Bank of India, you can see the demand. It's oversubscribed nearly 2 times. So, and for the first time, it's not just LIC, but FIIs who are showing interest. So, which means if PSU banks are allowed to raise external capital, we are fairly confident that they will be able to raise the capital.
So there is enough appetite out there despite all of these concerns.
Indeed.
What about NBFCs? Because banks, and I mentioned SBI again over here, have been aggressive in cutting down rates for the home loan lending portfolio. Is that going to squeeze out margins for NBFCs because they also have to remain competitive and follow suit over there?
NBFCs still, well, the margins will come down. Valuations have gone up, and therefore we are on the sidelines as far as NBFCs are concerned. But there's enough liquidity out there. And if you look at even corporate lending outside corporate borrowing outside the banking system, is now this year so far is about 55,000-60,000 crores, much bigger number than last year, because companies are finding it easier to, and faster, more importantly, to borrow it in the corporate lending market rather from banks.
Talking about NBFCs, let's talk about real estate. Now, it's been a stellar rally as far as real estate this year goes. The index is already up over 50% on a YTD basis. Is this a dead cat bounce, or is there more to it? Have things fundamentally changed for real estate?
I do not think it's a dead cat bounce, because the valuations are extremely cheap and still are for various reasons. If you look at land registration or even stamp duty apartment registrations, they're at a 10-year low.
Right.
And the biggest states, Maharashtra, Tamil Nadu, Andhra Pradesh, Telangana, they all cumulatively represent like 50-60% of total land registrations in this country, 4 or 5 states. And they're all at historical lows. And so, which means, and now you have RERA coming up. So urban demand will slow down further. So which means you have the existing real estate companies wanting to push out their existing inventory before they restart on a big scale of rebuilding, of building again, rather fresh building. So in this whole thing, and given that we are close to the end of the rate cycle, consumers, i.e. buying apartments, will probably continue buying, or rather accelerate their buying, because they waited way too long, haven't seen any big cut.
So you feel demand for home buying will pick up from
Will pick up.
And does that make you then bullish on the real estate pack, and then the corollary is the building material sector, as it were?
One, the real estate pack will also benefit from the fact that REIT will happen at some point, Real Estate Investment Trust. And second, yes, the building materials will do well. They'll do well not just because of housing demand picking up, but also the input costs going down.
Right.
And that's going to add to their margin expansion, and therefore, yes.
Paint companies, are you looking at that in particular?
Paint companies will benefit, one, because of this real estate demand, and second is they all get their raw materials which are oil-based. Oil is a fairly stable outlook, and therefore you'll see margin expansion.
And these fresh geopolitical concerns in the Middle East, Qatar and Saudi severing ties, anything to worry about over there?
I think Qatar is a very small oil producer, but doesn't really move the needle. So all the big boys, the Saudi and the UAEs, they're all together. So therefore, it's unlikely to impact oil prices.
And that OPEC price cap, the output cap, sorry, that's been there. Even if Qatar is to pull out, that won't change things significantly.
That won't change things significantly. So we think oil will be in that $50-60 range for at least for the next couple of years.
Right. So we've spoken about real estate. Let's talk about 2 other spaces. Let's talk about IT. Is this a contra play in the current market, considering the kind of rally that's been across all sectors? You're looking for value at the moment, or you're looking for the next sectoral churn, as it were, the next move that could come in. IT and pharma haven't really participated. IT, we know what the fundamental concerns are, but considering that there is nothing else in the market that's available at those valuations, should you bet on IT stocks?
IT, you will have a trading bounce now on the hope that maybe Modi, Trump can do something, which is unlikely, because H-1B caps are not based on one nation. H-1B caps is for all nations sending in employees to the US. So that's unlikely to do any meaningful change. Second, their valuations are actually okay. They're not particularly cheap. But given that the overall market, there will be a sectoral rotation, IT will probably make you a 10-15%, but nothing more beyond that, I would assume.
One thing, and IT, at least fresh hiring is slowing down. there have been layoffs over there. I know it's bad news as far as the economy and the working dynamics are concerned, but it pushes up utilization levels for all of these companies. Anyway, they operate anywhere between 70 to 75%. Could that be a positive as far as the financials of the companies go?
Yes and no, because the severance bit of it hurts the company's margins. The utilization bit of it will improve, but again, hiring in the US, which is higher salary-based workers, employees, will again increase the employee cost. So net, and then you have a currency hit, which currency is appreciating now. Rupee is appreciating versus the dollar. And therefore, net, we don't see any improvement. But utilizations in general have to move up, because you don't have any other industry which operates at 70% capacity utilization, and you should operate at 80, 85 at least. And so from that perspective, IT is learning how to operate at an 80, 85, which is good news over the longer term.
Good news over the longer term, but stay away from IT.
IT for now.
What about pharma?
Pharma, it's only a stock-specific thing. The problems are not going to be fixed, because when you're talking about compliance is something which takes a long time to implement, and each one of these companies is learning it the hard way, which will take time. So we do not own anything, nor do we intend buying pharma anytime in the near future.
So what are you buying right now? And I ask from two perspectives. A, what have you bought and are holding on to and see further upside ahead? And if you were to make fresh entry at the moment, what would you look at?
We are holding on to, we bought corporate banks, and I think we'll add more. In fact, SBI is a wonderful price. I think the stock does really well. 1 year, 1.5 years later, the stock goes far higher than where it is today. And so that's a space that we'll add. Second is capital goods / EPC spending. The government is a big spender, whether it's roads, renewables, solar, water, irrigation, big themes. Elections coming up, important for the government to show that they have to create jobs. And therefore, this space will do well. And all the related ones below that. The companies in supplying to irrigations, companies supplying to construction. Those are the sectors we will be. And three, chemicals and petrochemicals are going through a sectoral, cyclical uptick, not just in India, globally. And we're seeing that in various markets. And so those are sectors which I think we will add weights in the coming months.
So you feel the chemicals story hasn't played out fully yet? There could be more room over there.
Chemical plays, there is a long way to go. And these cycles are very long cycles. And they're operating at low capacities, and so therefore there is upside.
What about autos? I mean, the frontline ones are already at record highs, whether it's a Maruti or a Eicher Motors. Two-wheeler sales, bit of a mixed bag, as it's always been in that space. But really, if you are to place a bet on autos, what do you do? Do you go with the market leader, which already is at record highs, but continues to dominate the field and continues to gain from strength to strength? Or do you look at some of the smaller names down the line? Maybe that could be the more value plays.
Now, if you look at even the current quarter, you've had the passenger names doing better than the commercial vehicle names. Whether it was the commercial vehicle sales of Tata Motors or Ashok Leyland or even Eicher for that matter, they were all down anywhere between 10 to 20% year over year. On the other hand, two-wheelers and cars picked up post-demonetization. Now everything will slow down because of GST. Post that, assuming that there is this urgency on the part of the government to accelerate capital spending, that's good news for the commercial vehicle sales. So that's the space that we'll look more towards.
So churn could come into the
commercial vehicle space.
And the rural theme, two-wheelers?
Rural theme in general is good because GST is good news for them. If you look at most of the products, which are the common man products, the GST rates are below the existing tax rates, and that should spur additional spending on the rural spend. So which is largely good, and on back of a good monsoon, is good for FMCG as a result, and smaller ticket consumer durables, your Havels of the world and companies like that. Bigger ticket, Voltis of the world, they're going to face higher tax rates. But end of the day, I think the smaller ticket ones will see the first uptick.
Small ticket ones will see the first uptick. What about cement? Seasonally entering into a soft quarter because of monsoons, but like you said, if infra has to do well, if cap goods has to do well, if government spending is one of the themes, and of course housing, then cement should be one of the beneficiaries.
Cement has moved from like $60, $70 EV per ton to about $100. I'm talking about the smaller names.
Right.
And the bigger boys, the ACCs and all, are trading at far higher valuations. The discount is probably about 30% versus the large cap. And I think $100 is still, as a replacement price, is a damn good price, because you can't set up a cement plant at $100 today. So all the mid-cap cement players, especially the north and the mid, even south, because Andhra and Telangana is really strong, should do well. East is unlikely to do well, and west you'll have steady growth.
Let's talk about one of the smaller plays in the market, and that's financial services. I mean, it is a big play, but compared to the size of the banking universe, is that one of the spaces that could be gaining traction? So I'm talking about your insurance companies, or I'm talking about your brokerages, or I'm talking about some of your NBFCs that also offer other value-added services.
Consumer finance companies have done well. Now have all these microfinancing units have had the fair share of problems, will have problems because we're going into elections. So now what's left is this new space. You have a feeling, even amongst the the retail, that they've been left out in the current, for instance, stock market rally. So this is just one segment. Of course, there are various other segments which will see an uptick. Traditionally, if you go back any cycle in the past, it has happened. And so I think that space, yes, we will see strong lending numbers happening.
Are you fully invested in the market right now? What's the strategy? What are your cash levels at?
Well, some of our existing funds, yes. So we have a brand new launch, so we are deploying cash. Even though the market is at record levels, we are not holding back, because we believe that whatever dip, this is a post-truth market,
right,
where the opinions and outlook matters more than the existing reality.
Which is a dangerous thing, right? Because it's then buy on rumor, sell on news.
Well, hope is a wonderful thing, and it translates at some point, and we've been patient enough, and I think this is the point where we should now hold on to that.
So you're saying that some kind of base building has happened, even though you've had the 1700-point rally come in on the benchmarks. Maybe the situation is such that even if there is a dip, it won't be more than, let's say, 500 odd points. You will hold on to these gains.
There is likely to be a minor corrections along the way, simply because GST will create some confusion. Globally, things are looking fine. From an India perspective, for all the reasons, both political need to show growth is important. You look at the returns, stock market returns. This year has been very strong, but last year was only 2% Nifty went up, and the previous year was a bad year. So from that perspective, the markets are not, the multiples are only about 16 times, 15, 16 times on depressed earnings. So if and when earnings recover, then it is not an expensive market.
But that's anybody's guess at the moment.
At this point, yes, there are moving parts, and we have to wait.
Finally, you are talking about elections, and we are looking at general elections just about 2 years from now. What's the kind of reform agenda that you can see from the government? So bankruptcy law has been put in place, some form of real estate regulation, and of course the GST. So the key ones have been implemented. Next 2 years likely to be more populist?
Next 2 years, on one hand, the rural bit of it is, you're already seeing signs. Maharashtra has just announced a farm loan waiver. And then you will have a couple of, Gujarat has announced a farm loan waiver if they come back to power, of about 20,000 crores. So you are seeing that populist bit. But they do realize that job creation has not been there for the last, as it should have been. And therefore, there will be a push, I hope, to spur private capex, which is good news not just for the stock market, but more importantly for the economy.
But wouldn't that mean then that at least, RBI is, of course, is an autonomous body, but at least push for a rate cut then, because that could be one of the triggers at least to spur private capex?
Indeed, central banks around the world are growth focused or inflation focused. Inflation is at low levels, even by RBI's own targets, and growth has also come down. So it is imperative that from either one of its benchmarks, targets, whether it's inflation or growth, it all points to a rate cut.
But not happening tomorrow, at least.
Well, very unlikely to happen.
Unlikely to see a rate cut this time around, but there could be one in the offing. Chakri Lokapriya, a pleasure speaking to you as always. Thank you for joining us on this leg of Market Guru. With that, completely wrapped out on time over here, but thank you for watching.